We are now recording this session with Talking Hedge Events, and I would like to turn things over to Meg Bodie, the president and founder of Talking Hedge Events. Meg, all yours.
Terrific. Thank you, Ken. Hey, everybody. Welcome to our second webinar in our series that we're calling Toronto 2021. Sorry again that we can't be up there. It would have been our fourth, it would have been our fourth trip to Toronto. And we really do enjoy coming up there and meeting with people, obviously, in person. But we hope that everybody is well and safe and enjoying the beginning of summer here. I know it's awful hot in a lot of places, and it's been windy here. I'm on Long Island, and woof, Elsa really did kind of roar through yesterday in the night. Anyway, as you all know, we tend to be a little provocative, which is a good thing. The speakers that we have today are all revved up to really share a lot about crisis protection and tail risk, and they have some advice for you on how to set up a strategy to keep your portfolios safe and continuing to get some alpha as well. So I do just want to repeat, as I have said many times, that the views and the insights that they share with you today are their own and not necessarily those of the firms for which they work. So please bear that in mind. It's a truly exceptional discussion today. Let's get into it. I want to thank Graham Capital Management for supporting us, and delighted to have Ed Tricker with us today to be talking with you. I want to thank Efficient Capital and Lixor and InfraHedge and AlphaDense and Auspice Capital up there in Canada, and Bodie Research also in Canada, and FAR Capital, and O'Brien Investment Group, and Strix Leviathan. I'd also like to thank our association partners, AMA and CASA and Kaya. So delighted to partner with them. And let's get moving. Hey, Michael, why don't you turn on your camera? Ed, Nicholas, Brandon, and here's this fabulous panel. I'm going to log off and have a great time.
Thanks, Meg. And thanks for everyone joining us today. You should see some polling questions coming up in a second. I want to call your attention to one in particular, which I'm going to ask the panelists to answer as they introduce themselves. So at the end of 2019, there was a sense with a lot of people that the bull market had gone on for a rather long time. So now that we've had the crash in 2020 and a full rebound, the question just is the value of tail protection higher or lower now than it was pre-COVID? So with that question in mind, Brandon, do you want to start off with an introduction and a view?
Sure, thanks, Michael. My name is Brandon Gill. I'm a senior portfolio manager at OP Trust. We are a defined benefit plan based out of Toronto, and we manage about 23 billion Canadian in assets. We are somewhat of a mature fund, and therefore we invest in what we call our member-driven investment strategy. And the idea behind that is that we would like to be able to deliver pension certainty to our pensioners. So we tend to manage the portfolio with a mind towards lower volatility, and we want to make sure that we hit our funding targets. We're fully funded. We want to be able to keep the fully funded position with the lowest risk possible. So we prefer a steady, stable return profile. At OP Trust, I work on the capital markets team. We invest in public assets on behalf of the plan, and I work within a smaller team that invests specifically in external managers. And this portfolio manages across all asset classes in the public space, from ranging from public equities to credit to hedge funds to other more esoteric strategies. And then in terms of tail risk, at OP Trust, we do apply a tail risk strategy at the total plan level. We call that our risk mitigation portfolio because we want that pension certainty that I was describing a minute ago. But we also consider tail risk in our hedge fund portfolio, which I am directly involved with. And so we use that there as well, or we mitigate our tail risk there as well. In terms of your polling question, that is an interesting one. By definition, tail risk, tail event is an unpredictable event. We can't time it. We don't really know how to time that. we certainly don't know how extreme that tail event will be when it does happen and the characteristics of that. So that makes it quite challenging to value. And then the value of that will differ depending on investor. So, and their profile. So I would say it's a bit difficult to answer your question at a very blanket level to say, that this is a good time for value. There is value in this or there's not. What I can say is that we did have our risk mitigation strategy on at the total portfolio level prior to the COVID crisis, and that really kicked in nicely when we needed it, and it did help us stabilize our returns throughout the crisis. We did adapt it after the crisis. We did change some of the characteristics of that hedge. We kept it on, and we're currently very happy to have it on now, especially since the market has rebounded so much post-crisis.
Yeah, thank you. Ed?
Got it. So first of all, thank you for the organizers. Thank you, fellow panelists, and for those of you that are tuning in. I think we all appreciate the opportunity. My name's Ed Tricker. I'm the Chief Investment Officer of the systematic or the quant business at Graham Capital. Graham's an alternative investment manager. We're pretty well established. We were founded in the mid-90s, so it's been around over 25 years now. The firm has grown to employ over 170 people, and we manage about $18 billion or so in assets. In terms of the polling question, I think I try and steer clear of market timing calls. I found that's advisable in my profession. I think saying that tail protection is more or less valuable because stocks have gone up or down a lot is dangerously close to a market timing call. But I think last year was a bit of a wake up for many investors. I think people had forgotten that stocks can go down and it's unpleasant and they can go down quite a lot. And it's reinforced the need for something like a tail protection or a risk mitigation strategy in many portfolios. I think also we've all become, dare I say, a little complacent because many of us have had some form of risk mitigation or tail protection in our portfolios passively. Fixed income has been really rather nice. It's worked every time stocks has gone down, and it's also generated a fairly compelling long-term return as well. That's an exorbitant privilege that doesn't come along all that often. And I think it's almost certain that fixed income is not going to look the same in the next 20 years as it has in the last 20. So that's had a number of people revisiting their portfolios and asking, okay, this thing that I had maybe more by luck than design is probably not going to be so good. I need something to fill those very sizable shoes. And they're starting to look at alternative solutions to this tail hedging problem.
Thanks, Ed. And Nicholas?
Thanks, Michael. Thanks, everyone, for having me here today. I'm Nicholas Stein. I work for CNREL Pension Fund. We're based in beautiful Montreal in Canada. We're about 90 employees managing about 19 billion of assets in Canadian dollar. I oversee the absolute return activities. So it includes investment in hedge funds, alternative risk premia, and also tail risk programs. For tail risk, we have both external allocations and also internally managed strategies. For the polling question, I guess we've seen a significant V-shaped recovery on equities. And when we look at pricing and volatility, things are now at decent levels for thinking about adding potentially to the hedging program. But I think the key question is, are we still sensitive to downside risk? And that remains for us. So that's really, at the end of the day, that's the key question to answer. So I would say yes here.
Great. Well, thank you, Nicholas. And so getting into the topic, one problem with talking about tail risk or tail hedging is that people aren't always clear about what they mean, and they don't always define the specific risk-off scenarios that they're worried about. So, Brandon, how do you define risk-off scenarios, and how much are you looking back at past events to sort of form your view of the world?
Yeah, that's a good question. Really, tail hedge and defining a risk-off scenario has to be a bit portfolio specific again, so it depends. And different portfolios are vulnerable to different types of events. So the effect might be very different for our plan versus another plan. So it has to be quite bespoke, I would say, to the vulnerabilities of the portfolio. And at OP Trust, given our mature profile, we're running lower volatility generally on our plan versus our less mature peers. But in terms of the process and looking at historical information and scenarios versus future forward-looking, we do both. We had spent a lot of time constructing a total portfolio risk mitigation, portfolio a number of years ago, and that took actually quite a bit of time, and it took a lot of integration between all of the different teams across the plan. But we did rely significantly on historical data to start that process as a tool, I would say, and then we added forward-looking views to that. And so we did look to understand, what vulnerabilities we have as a plan, and that was very data intensive. We wanted to understand what assets would actually work as risk mitigators for those vulnerabilities. And we evaluated a lot of scenarios. So we looked at this portfolio over lots of scenarios. And then we tried to come up with permutations of risk mitigants that could actually increase the probability of actually mitigating risk in a downturn. And that was actually quite a bit of work. And all of that was quite historical looking. But at the end of the day, we did create a basket of assets that we thought would kick in different times in different scenarios, and that would be the safest basket of assets to invest in. But at the same time, we did apply a forward-looking view. And, for instance, we kind of started with this basket of assets pre-crisis. It did have a significant asset allocation to fixed income, to Ed's point, and that kicked in really nicely, when we needed it to during the COVID crisis. However, we did monetize that because we did have a forward-looking view that it was going to be a much more challenging time for rates, and we were going to be able to depend on those on a go-forward basis. So we're constantly kind of evaluating with this basket of assets the risk reward on a go-forward basis. So it's a bit of both.
And how does that differ, Ed, from an asset manager's perspective?
Got it. So I guess I have two problems when it comes to designing a strategy like this that I have to contend with. The first is, as you say, look, I can ask two different people what they would define as the crisis, and I'll get two radically different answers. Some people won't break sweat until stocks are down 25%. Other people will run around in a blind panic every time stocks go down 5%. And the solution I would propose in those two scenarios necessarily has to be radically different. So there's no one-size-fits-all solution. The way I sort of contend with that is you have a well-stocked toolbox, and you can use different tools, so different sort of programs, different strategies to try and fix whatever problem it is that people have. But each combination is going to be different because, as Brandon said, each person has a slightly different problem they're trying to solve for. So flexibility is certainly key. The lack of data is also a challenge. I'm a quant at heart, and quants love data. The problem is the plural of anecdote is not data, right? And you look at crises and tails, and by definition, a tail is something that is infrequent. The number of times stocks have gone down a lot in the last 20 years, you can probably count that on the fingers of both hands. So it would be unwise to make some heroic assumption based on such a small number of instances. I think another compounding challenge is that of the small number of instances that we have, they're all different. Last year, stocks fell 20% in 2 or 3 weeks. Other times, stocks have fallen 15% over 6 to 12 months. And again, the type of solution you propose to those different scenarios is necessarily quite different again. So we're definitely working with a very small subset of data. It's a challenge. It's not an insurmountable one. One thing I like to do is to rely on things where the data isn't quite so important in predicating their future success. So things where there's some structural component to them, I think they have an advantage in a situation like this. So at an extreme, you'd have something like an option. An option's, it's going to work. There is no uncertainty. As long as the conditions of that option are met, your put option is going to pay out if markets go down a lot. Similarly, systematic strategies, because the rules are codified, there's less uncertainty. A strategy like trend following, if the markets go down a lot, trend following is going to get short and it's probably going to make you money. Now, the when that's going to happen is still an issue, but at least you've dealt with the if it's going to kick in or not. So that helps mitigate some of these problems. But it is certainly an issue that all of us face. And I think an over-reliance on backward-looking data and not enough sort of common sense and interpreting the forward-looking potential scenarios, that could be very risky indeed.
Yeah, and that the rarity of tail events brings up this other problem of how do you evaluate a tail hedge program? So like Nicholas, if someone comes to you in year 6 of a bull market and says, "Is your tail hedge program working?" How do you answer that? How do you evaluate success at those times?
That's a great question. I think we put ourselves back to 2019 at the end of the year. It's a tough question, and it's not just based on outcome because we have to remind ourselves that tail risk program is buying insurance, so it's a kind of negative expected return proposition. So the outcome that if you're losing money after 6 years and you still have the program on, maybe that in itself is a success of the program, meaning you have the right governance and you have the abilities to stay in and wait out an event. So maybe we have right sized the program in a sense. But how do you measure success for a hedging program is specifically important. And many sophisticated investors were caught, forced out of a hedge program late 2019. Coincidentally, 2020 was a big event, so that is difficult. So the question speaks to the difficulties and realities of running a tail risk program. Again, relating to timing, sizing, and hedging fatigue. So what we found that if you look at the hedge program on a standalone basis, we have benchmarks that helps us identify and assess the quality and the outcome through year in, year out. And that becomes relevant when you look at standard hedging programs adjusted for the delta that you're trying to hedge. So call it like a 10% out of the money put index or put on S&P 500. If year over year you're able to outperform that is one thing. But then when the year that there's a big event in markets like 2020, you have to participate. You can't just be on the sideline and cost cheaper. So that's one way to measure a tail risk program on its own. But most often, I think the more important is tail risk program is a makeup of a entire portfolio construction. So akin to, I'm Canadian, so I'll compare it with playing hockey. If you have a very strong defense, maybe that's going to help you play better offense. In a sense, at the plan level, the fact that we have a hedge program on helps the investment team really focus on, probably a big word here, but stepping on gas and really outperform on the risk and on the return-seeking assets and the alpha strategies. And knowing there's a safety net behind them, it allows us to be better risk takers. And overall, I think we can offer a better risk-adjusted proposition, including the hedge program. But there's also thoughts about, do we want the hedge program to be a permanent allocation? At this point, we don't think so. We think it's more tactical. But tactical means there's a timing component as well. So the KPIs, as we call it, is really important to kind of speak ahead and discuss that and manage expectation around those. Those are very important points.
Yeah. And Brandon, do you have a similar or different approach at OP Trust?
Yeah, I would agree with much of what Nicholas has said. I think when you're at the end of at the 6th year of a bull market, you're not going to know if you're successful or not, and you shouldn't actually try to know if you're successful or not. And likely many of your colleagues are pressuring you to take this off. And so if it exists, I think that is success in itself. But you will know when that event happens and when it kicks in. And that's really when you're going to be able to test it. If you put your tail hedge on and you spent the premium for that hedge and it doesn't kick in when you want it, that would not be success. And I have had many people ask me when we're talking about our own risk mitigation strategies in our hedge fund portfolio, I've been asked about the Sharpe ratio and people want to look at them on a standalone basis, but it's a completely irrelevant metric to kind of evaluate these on. You really need to look at them for when they're going to kick into your portfolio. And then I would say, in terms of approach, we are, what I would say is we're not timing this, and we don't want to be able to time it. We put this risk mitigation portfolio on at the total plan level on a long-term basis, but we adapt it to the circumstances. And so that's probably how our approach may differ a bit from CN.
And Brandon, you also mentioned that you have a tail hedge program at both the plan level and within the hedge fund program. How do those differ? How does their role differ?
They're quite different, actually. So if you think about it, the risk mitigation portfolio at the plan level is really mainly to offset any risk that you're going to be experiencing in long-only assets. So, that's really to mitigate your equity risk, your long-only credit risk, and make sure that the total plan doesn't, can preserve its returns. And also you'll have opportunity coming out of that crisis. At the hedge fund level, it's very different because by definition, your hedge funds are hedged. And they're long short in various ways and to different degrees. And so you really have to go through a much different process to understand what your exposures are there and where your vulnerabilities are, I would say. So I would say first off on the hedge fund portfolio, it comes down to portfolio construction in general and making sure you have a real range of types of strategies and styles within your managers. So we would look at everything from strategy, style, tenure of trading. Is it a short term or a long term, slower trader, geography, and the tail risk characteristics of each underlying strategy. And again, we use, similar to what I was saying with the risk mitigation portfolio at the total plan level, we are using backward looking data as a tool, but it doesn't, and it helps us understand these characteristics, but we still apply forward looking views to that portfolio, even though it is quite different. And one thing you will notice is that, all different managers have different characteristics. So for instance, you can have a manager who is really good at hedging their own exposure. You never have to worry about them, and you don't have to offset their risk. Some do that better than others. So you need to be quite aware of those characteristics. I think that, short-term traders can and not always be a little bit more resilient in a downturn versus someone who's very buy and hold. And then sometimes, your market neutral strategies, at first blush, someone might think, well, that could be very well hedged, but they're extremely susceptible to deleveraging scenarios. And so that will get hit in a tail, even though it's market neutral. And so that's something that you need to understand about the portfolio. And so what we really do is kind of look at all of that data. We look at coincident tail sort of characteristics of our funds throughout the portfolio. And then we marry that with a forward-looking view of the manager and what their approach is at the time, what we think how they're going to be positioned going forward. And we do end up adding a bit of a few strategies to this portfolio that we think are going to kick in at a time when the markets do go down to really offset that and create a more convex portfolio. So to answer your question, it's using the data as a tool, but also, using forward-looking views. And it is a bit of a different process than it would be for that long-only risk mitigation portfolio.
Yeah, and Nicholas, what about you with the different hedging programs that you have? Do you also have different processes for them in place?
Yeah, no, we do, and I think Brendan spoke to a lot of key points. One of them is about being able to identify the risk that you're trying to mitigate. So at the pension fund or the plan level for us is mostly mitigating the equity downside risk. And that is set at an attachment point that is fairly more aggressive, meaning a big correction. And how we define that is severity about 15% drawdown in equity markets for our timeline that the correction would happen over a period of 6 months or so. Whereas the hedge fund portfolio, because it's more hedge in a sense, it's very much absolute return driven. We have very different set of risk, and also we're exposed to different asset classes. So you'll see the hedge program within the hedge portfolio, in addition to risk managed strategy, we traffic across different asset classes and type of strategy and time horizon. I think it's worth mentioning that when we look at on a vol adjusted landscape, hedge funds tend to reduce risk in higher volatility markets, so vol targeting, whereas the pension fund has a strategic asset mix that tend to potentially rebalance and buy assets cheaper. So if we vol adjusted, the pension fund will take more risk in volatile markets, or it's the opposite for the hedge fund program. So you can imagine that for us, the most vulnerable situation is actually for the hedge fund program, the first 15% drawdown in markets is probably more we're more sensitive to, rather than 15 or more at the pension fund. So that utility function differential makes us have different approach. Although on the equity side, I have to say, we have done a lot of work in incubating hedge strategies across different asset classes within the hedge fund program. And the program that we have for hedging, the total plan is actually the same program that we use for the hedge fund. So we see that there's certain things that we can adapt and scale up, and we calibrate it differently for the pension fund as we are hedging specific risk there.
So another issue is, and this has been mentioned a couple of times already, is the challenge of governance. How do you educate stakeholders and stay invested over a whole market cycle? Ed, how do you see your role as an asset manager in sort of assisting and educating stakeholders?
Got it. I think it starts, it's not the most profound statement I'm going to make, it starts at the beginning, right? And I think too often the objective is not very well defined. People will say, I want a tail strategy to, quote, make money when markets go down. But what does that mean? That's not a problem that I can really solve for. What markets are people talking about, and what does go down mean? Does it mean going down 5%, 10%, 20%, etc.? And I think it's vitally important to establish these things early on, to communicate them effectively. Otherwise, you're going to end up with some of your stakeholders getting annoyed at some point as their expectation of what constitutes down does not match up with somebody else's. So a well-defined objective is certainly very important. I think then it's about, okay, we know why this thing is in the portfolio, but when should it be necessary? Is this something that you should expect to hear us talk about once a month, once a year, once every 10 years? I think it's impossible to say that for certainty, obviously, but if you're talking about stocks going down 10%, you're probably talking about once every few years. This is not something you're going to be talking about every second Friday, for example. So trying to put some bounds around that are helpful. Then when it does happen, what should we expect to see? Is this going to make 1% for the portfolio, or is it going to make 20% for the portfolio? And again, you can't say that with absolute certainty, but trying to put some parameters on it, I think, is very helpful for people. And then finally, I think one of the challenges certainly I face when explaining systematic strategies to people, and I do think that the best tail hedges are systematic because they're so process driven and so reliable. There is this expectation that it's a very opaque thing, that people don't understand how it's doing what it's doing. And that can mean that people become quite intolerant of it quite quickly, particularly if it's not making money, right? People, if they don't understand what it's doing, then they're very quick to throw it out of the portfolio with some of the risks that we've already spoken to people about. So I think making sure that the strategies are as transparent as possible. As we've already mentioned, something like time frequencies that are involved, giving people an idea as to what's going on there so that, hey, look, this strategy looks at a month of data. So if something goes really wrong tomorrow morning, it's not going to catch it straight away. That type of management of expectations, I think, is key as well. So if we can get all of those things sorted out well ahead of time, it helps manage expectations on an ongoing basis.
And Nicholas, what about from the asset owner perspective? How do you work to get buy-in with this kind of program?
Yeah, I have to echo Ed, and those are great points. I mean, KYC, know your client, but know yourself as an investor as well. I mean, that's the most important. We have to be very clear with the why and the how. And one of the things that we found very helpful is to communicate multiple scenarios. The good, the bad, and the most important, the ugly. That to us is it's about managing expectation. There's unknown out there. We can use past returns to help us create soft boundaries regards to future expectation of returns. But most often, there's a saying: you're always hedging your last, crisis. Every crisis is different. The path dependency is important to understand. So I'll reiterate is not to be afraid to talk about how things can go wrong and how things can go badly. With that, you'll be able to then think about, position sizing, risk tolerance, have a gauge of that in your governance in your committees. And I think the most important risk to avoid is the risk of being stopped out. Hedging fatigue is a real thing. And at the end, if you're able to hold on onto your hedges and your strategic asset mix perform well as expected, on the other side of extreme pain for your hedging, maybe there's huge reward. But that's obviously a point that now I'm belaboring here. The other point is, do expect an evolution of this program. Markets changes over time, so we expect to change as well and make improvement. But those improvement needs to be communicated well and clearly on a frequent basis to our committees and our governance to be able to again have the buy-in and the support in thick and thin time with this program. It is very difficult to run a hedge program. So lots of scar to share further with the panel here.
Yeah, and you mentioned that if you get through the hedging fatigue, there's a future reward, but that also requires preparation and good governance, right? So what's your approach to monetization?
Yeah. Like I was saying, we're a fan of more systematic type of strategies. They are more predictable in a sense and more reliable. So we have hard-coded systematically our monetization process. Not trying to overly optimize to time the market, but there is a point where there's value to shore up some of the profits and give that profit to the rest of the pension fund, where they can either reinvest in asset classes that are very attractive or just pay pension fund. So we're very explicit about profit thresholds, and there's also implicit monetization in our system by way of just rebalancing. We'll have run several strategies. Sometimes a strategy outperform and does very well. That is very path dependent or very unique or idiosyncratic to the markets, and we're able to shore up some of the capital and reinvest within the hedge program as well. I think it's I find that programming the monetization really helps, because I want my team to be really focused on the process and not focus on timing the market and having the burden and the stress and the pressure from the activity to play heroes. It's hard to evaluate a market when the noise is really, really high, and then with the rest of the pension funds not doing well. So you have the pressure is really high. So again, programmatic and very systematic, but that's only one approach. On the hedge fund side, there are discretionary strategies, and those are basically continued conversation with the manager. Some of the managers outsource to the client the monetization. Some of them have embedded. So it's a mixed bag, and it's really about knowing each other and the utility function or the reaction function of each side. It's an ongoing dialogue, and with time, we've learned a few things. And we still find that programmatic, or at least even if it's discretionary, that is a rule-based discretion, if I can put it that way, is much helpful.
Good. And Brandon, is your approach to monetization, is it also systematic? Is it more discretionary?
I would say ours is a combination of both. Especially in our total portfolio, risk mitigation portfolio, we do have, some plain vanilla assets in there, but we also have some CTAs and more systematic strategies in there acting as protection. And then the way we think about monetization, at least at that total portfolio level, we don't just throw the hedge on and forget it forever. At the same time, we're not timing that hedge, but we are opportunistic, I would say, and adaptive. So we're kind of a little bit in the middle. we'll set that hedge. And again, as I use in the example of that fixed income was a piece of our risk mitigation portfolio. But over time, the portfolio construction team at OP Trust is always evaluating the risk reward of these assets. And definitely, alongside with our fixed income team, felt like the risk reward wasn't as appealing in fixed income. So we did tweak that portfolio. We ended up doing a bit more kind of nuanced trend strategies instead, to get and adding a few other assets to get that protection that we needed for the portfolio at the time. So it's dynamic, but we're never going to be taking that risk mitigation portfolio off and timing that on an overall basis. And then I would say on the hedge fund side, I would echo Nicholas's comments. You're constantly speaking with the managers and understanding their characteristics and what your overall profile is going to be. And that is fairly dynamic and it does change over time. And so what we would do is with our strategies in that space that are a bit more protective for the portfolio, we would just sort of tilt in and lean in and out of them. We would, again, never redeem all of our risk mitigation strategies or try to time that. But, there might be moments when we think, we don't have enough protection in the portfolio. And maybe at a higher level, the plan is feeling a bit more cautious and we might just lean into that a bit more than other times. So we because again, when you invest in fund strategies, it's not that easy just to pull them on and off so quickly. So you use your team or your bench to sort of tilt in and out.
And Ed, do you see monetization? It's your responsibility. It's the clients. Does it depend on the mandate? What's your approach?
Yeah, I'm glad to hear there's not too many attempts at timing these things going on, because timing it's incredibly difficult. And sort of a moment of confession that I'm incredibly fortunate. I have sort of 40 men and women at my disposal whose job it is to sort of help design strategies like this, and they're a super bright, super hardworking group. More degrees than a thermometer. These people collectively, we have not found a compelling ability to time these strategies. Now, look, I'm not so arrogant or so naive to suggest that because Ed's not done it or because Graham Capital haven't done it, it's impossible. But I'd venture to say it's very, very difficult to do well. I think one of the challenges is the deck is kind of stacked against us early on. Tail strategies, they make and lose money in quite an idiosyncratic way. They tend to lose money slowly over time. There's a sort of a drain that comes sometimes from these strategies. But when they work, they make you a lot of money in a very short period. So they're very asymmetric in the way that they generate returns. Asymmetric returns, unfortunately, come with an asymmetric risk. And asymmetric risk is something that investors we should generally seek to try and avoid. The asymmetric risk here is around timing. So you can imagine you have your tail protection strategy and it loses you, I don't know, not a very good one. So it loses you 1% a year on average. And you think, right, it's time for it to go from the portfolio. I've got to take it out. But you know what? I'm going to leave it in there for 6 months. So you're 6 months late taking it out and it's cost you 50 basis points. And that's annoying, but 50 basis points, it's not going to break the bank. It's not the end of the world. Now imagine you took it out 6 months too early and you think, great, I've saved 50 basis points. I'm going to tell my boss, he's going to think I'm a genius. And a crisis happens. And all of a sudden, yes, you saved 50 basis points, but this thing that was in there to make you 10%, all of a sudden isn't. And because it's so difficult to time when that event happens, you run the risk of it happening, and it happens in a very impactful way on your portfolio. And it's a highly, highly asymmetric risk. So for that reason, my sort of advice and inclination is always to keep these things as a core allocation within a portfolio, sort of echoing Brandon's comments that you can change the makeup of them to a degree, but let's keep the thing in there. Look, if the concern is that 1% a year that it's costing, there's stuff you can do to defray some of that cost without sort of rejecting the entire concept. You can certainly become much more creative around the composition of these tail protection strategies, maybe to help you better achieve your objectives. But these things do sometimes get thrown out at just the worst possible time with a much greater risk than people realize. And I get it. It's because one of the risks is fixed. It's accruing every day, whereas the other one, it might happen in the future. But we all need to do a better job of realizing that the opportunity cost is real and it can be quite unpleasantly large.
Yeah, mentioning the different compositions, I think we've seen a lot of funds and products in the last couple of years that are trying to reduce the bleed in a variety of ways and presumably will offer less convexity in return. Is that something, Ed, that I guess you feel like should be a part of the conversation when we're talking about tail hedge, not just the traditional high bleed hybrid?
I think so, because it's sort of taking us full circle that there is no one size fits all. I see tail hedges as existing on a spectrum, and at one end you've got things that work really, really well and very, very reliably. They're hugely effective. They're also very, very expensive. And then at the other end of the spectrum, you've got things that generate a pretty nice, compelling long-term return. They don't cost you anything. In fact, you could just invest, say, in equities. However, when equities go down, your equities are probably going to go down. So there's always this competing sort of pressure between things that generate good long-term returns, tend to be pretty poor in times of crisis. Things that are pretty good in times of crisis tend to have pretty weak long-term returns. Now, people don't, it has to be said, fully appreciate this. The number of times people come to me and say, can I have something that makes 10% a year and makes 20% every time markets go down? I mean, if you find something, let me know. That I'd be very curious to hear about it, because I can maybe do one of those things. I can't do both simultaneously. That compromise is inevitable. Now, fortunately, very few investors live at the extremes. Most people exist somewhere on a continuum between these two. So I think having that discussion with people, finding out what is most important to them, what's nice to have, what they can live without, that can help us try and work out what it is they're trying to do. Then I can reach into that toolbox I mentioned earlier, and we can start to put together a portfolio that achieves that objective. So if they're most concerned with short-term crisis protection, then there's going to be more options. There's going to be more long volatility strategies, things like that. If they're more concerned about something that works most of the time, maybe not every time, but can actually make them a few percent when it's not needed, then I'm going to push them more towards, say, a broader quantitative macro or a trend following type of strategy. But having that discussion is absolutely vital, understanding what the objective is. Then we can try and solve it. I think too often people sort of come with this ill-defined objective and they sort of expect us to magically just go and do some mathematics and some outcome will be produced. But it's all about specification is key. But then I think you can get some very nice solutions, things that actually have a much lower cost than people would expect. In fact, you can get things that actually, in all likelihood, will make people money while still offering compelling downside returns. So there is plenty of room for creativity.
And Nicholas, I saw you nodding along to part of that. Would you say that these kind of lower bleed, lower convexity strategies, do they play a role in your program?
I think they definitely should. And I think in anything, diversification is key. So that includes also your hedging program. We're forced on the asset side to diversify, but have a hard time having investors push for one mousetrap and think that would work. If things are path dependent and different hedges work for different market conditions, and I understand that some want a hedge to work when correlations 1 on the downside. That's probably when markets are down 20, 30, 40%. But in interim, there's a path. And also the fact that you'll likely sit on these hedges for a very long time to Ed's point. So in interim, diversifying a set of hedges around the core that has potentially low basis risk is really important. Because sometimes event or tail event happens locally in different asset classes, different markets. So that helps you with the staying power, or meaning, you'll probably cost less over time by adding these, but to rely on just one or two is too high of a risk. I guess the other point is about scalability. Hedging program for $100 billion fund versus a $5 billion fund is very different. You get more creative for smaller allocation because certain strategies are capacity constraint, but in itself, capacity constraint includes certain risk of illiquidity, especially during time of hardship. So it's there's a big menu out there. It's getting more and more sophisticated, and it's getting harder and harder to fully understand the spectrum. but at least the choices are there for investors. I would say diversify, and these products, we do have them, especially on the hedge fund side, where we span across different asset classes, and trying to produce sometimes alpha as well as just more than just managing just the downside for equity.
Thank you. And we have a few minutes for questions if people want to ask, and maybe we can look at the polls while people are typing their questions. Let's see. So it seems like interesting. So a lot of people feel like tail hedge has higher value now than it did at the end of 2019, whether there were some votes for the same, for not market timing. Okay. And what keeps, and a bear market in equities seems to be the thing that is worrying most people, and inflation after that. I'm not going to go through all of these poll questions, but I think the participants can see them. Okay, so questions. And I'm just going to fire these out, and I think anyone who feels like they want to can jump in. So first, what is the biggest misconception investors have about tail risk?
So I can take a stab at that. I think one of them is that they expect them to lose money over time. In some ways, my job would be slightly easier if I could convince everyone that the tail strategies are expected to lose money, and then hopefully, if mine generates a modest positive return, I look exceptional. But I think the reality is people have become conditioned into thinking these things are very, very expensive. They need not be. I think is that with a few minor compromises, you can end up with a strategy that actually looks a little bit like fixed income has looked for the last 20 years. I mean, fixed income was a great tail hedge, and it made you 3 or 4% a year as well. To me, that is a lofty objective that we should all aim towards. It's not a perfect hedge, don't get me wrong, but if we could produce something that looks like that, that would be very attractive to a large number of people.
And another question. This, I think, maybe is more. Oh, Nicholas, did you want to jump in on that one?
Yeah, if I may,
Yep.
Let me take the other side of it, and I totally get where he's coming from. In my mind, in managing expectation for the same power tolerance program, I think it's easier to say that over time, there's a negative bleed or a bleed to negative expected return to the fund. But I think it can be shown that during a certain market environment, be it monetization, be it diversification, you can have a program that actually does very well even in up markets. Everything's relative, especially compared to the easiest kind of let's buy a put option on S&P and roll it over time. I think we can do much better than that. So that's the add-on. I would say.
The next question, I think this maybe is for mostly Brandon and Nicholas. How do you communicate and quantify your tolerance for losses during a bull market? Yeah, it's interesting. I'd be curious. How do you gauge the pain tolerance from like a board or other stakeholders who maybe doesn't think in the same quantitative terms that you do?
Yeah. Maybe I can start. We find that using a benchmark that is called a naive or a generic hedge is really helpful. If you roll a 1 year, at the money or 10% out put option on equity markets, that's the base case. That's where most people can traffic and have a generic hedge. If we can do better than that or be as painful, that's the threshold. There's ranges around that, but I feel like that's probably one of the key reasons, and also the opportunity gain from being able to play offense. What can you do better with a safety net is really important. So not look at just in isolation, because it's a very difficult conversation. It's holistically, are we better off net, and that I think helps.
Yeah, and I would just add, it's all about, this is all about communication, and to the extent you can use data to help make a case, I think that's always helpful. So in our case, I think at both the total plan level and with our hedge fund portfolio, we are very I guess we discuss a lot, and we're very communicative about where our tolerances are. And as I expressed, earlier on, we don't have a lot of tolerance for big drawdowns in our total plan, and also culturally in our multi-strategy portfolio, because we are feeding up to the total plan. We also have a little bit more tolerance there, but again, it's not as high as it might be in some other organizations. And so what we really do is try to show lots of scenarios. We do show the costs. When we decided on this total plan risk mitigation portfolio, we did run lots of scenarios, and we did show everybody that was on the working group committee, this is what we'll lose, this is what we can gain. It was very explicitly laid out with data, because I think people do tend to feel more comfortable when data supports things. And I think even on the hedge fund portfolio itself, we are very much communicative. When we talk about our portfolio construction, we always have our targets, we always have our drawdown tolerances, and we show sort of how and when these mitigators will help. And we do try to illustrate how convex the portfolio is generally. So I think it's really important to quantify and communicate in a way that's going to make sense, and even to your board level. And I think I think for us to get to Nicholas's point as well, the fact that we didn't suffer a huge drawdown last year was good, and it was real proof to the board that this was important. And I think it will make the case to continue this going forward. But we were able to do a lot, and even, access more opportunities, because we didn't have that drawdown, and we took advantage of a lot of that dislocation. And then you can quantify that as well in performance. So I think all of that really helps.
And we're pushing time a little bit. We have a lot of great questions. I can't get to all of them, but one person asked, I feel like we haven't addressed this at all, really. How do you think about sizing the tail hedge program, especially for the total plan? Does anyone want to address the sizing issue?
I could start. I think it's a path. Start small and get used to, the sensitivity, or the reduced sensitivity to drawdown. And understand that if you start small, everybody start looking at it, and understand that now. I get calls and emails after 5% drawdown, after 10% drawdown, etc. But it helps with communication. It helps with managing expectation. Sizing, it really depends on the outcome, and scenario analysis can help definitely, and quantify how much call it profit you want to get out of your hedge program for a certain outcome, and what's the pain on the other side for your real assets or your return-seeking assets. And I think it has to be right size, in the sense that it can't be too big to be too much of a drag, so that it creates annoyance or hedging fatigue. So getting back to that point, and for the hedge fund portfolio, we hedge it to a certain level of profit again, and that's why we need to be very clean cut and clear about when to monetize and how to reinvest that capital. It's a range. To be honest with you, it can't be a number, and that range fluctuates over time. But that's how we think about it.
I would say I think rarely people size things large enough. I'm going to say that, obviously, as a manager, I should say that people should invest far more money in strategies like this. But the reality is, if you're turning a 15% decline in your portfolio to a 14% decline, I don't know, was it worth it at the end of the day for the headaches that one went through? So you do need to size these things that they make a material effect. Now, of course, I am sympathetic to the difficulties and the pressures involved in doing that. However, I think when we size them, if we're jumping through these hoops and having to make the case for strategies like this, it is important to make sure that when they are going to be required, and it's not a case of if, it's a case of when they're going to be required, they are going to have a beneficial impact on the portfolio at a sufficient level that it actually makes a material difference to what will happen in the future.
And maybe to end, if each of you want to give one piece of advice for someone who doesn't have, but is thinking about starting a tail hedge program, what would that be? Nicholas, do you want to start off?
Sure. I guess it's like the best advice would be like to continue to reach out and speak to, you know, investors and managers that have been doing this, and maybe sharing of scars and horror stories is helpful. And I don't want it to say that it's only that. It is a very difficult thing to do. Tower risk management is probably one of the more difficult aspects of portfolio construction, but there's a lot of reward for that, and it serves a purpose. I guess Ed mentioned most investors have wrong way of symmetry. The pain on the downside is much higher than the benefits on the upside. But for tail risk hedging, the asymmetry is the opposite side. It's just taking, there's huge reward, and if you can hold into it, it's great. But I would rather learn from observation than from experience. So that means that just keep on reaching out, and I do so both on sharing my scars, but also understanding how people structure certain things. And to Ed's point and to your question earlier, there's so many new products. The evolution of this part of the industry, the spectrum, is significant. Lots of innovation, and it's probably too hard for one person, one team sitting in Montreal to be just understand all and be well versed to continue to reach out and participate in these panels, because I feel like I learn more than I add value. But that's my advice.
Ed, what about you?
So I think it's important for people to take a step back, and at the risk of repeating something I said earlier, I think a few things that are important. Thinking about why it's there is key. Is it for when markets are down 5%, or is it for when markets are down 25%? I think thinking about when it should work, and is this something for a rainy day, or is it something I'm expecting to see, twice a year? I think what it's going to do is important, and establishing that, and then loosely sort of how it's going to do it. And then once you've decided that, having those conversations, as Nicholas said, with people like the panelists, I'm always happy to have this type of conversation with people. But I think going in armed with that why, that when, that what, and that how, I think if we can start to address those, then there's a high chance of something like this being successful.
Brandon?
Great. And I would just add, I would be very deliberate about this tail strategy, and acknowledge that you're paying for it, and be very aware of getting and definitely get the buy-in from all of the relevant stakeholders to have that on, and make sure those stakeholders are well educated. I've just seen too many times, and I've witnessed it a number of times, where teams have experienced this bleed. They've had the hedge on, they experience the bleed, and then they take it off because somebody else, a new team comes in, or new boss or something like that, and the hedge comes off, and then the crisis happens immediately after that, and they get the worst of it, right? They've paid the premium, they've paid the bleed, and they don't get the benefit of the hedge. So I would just, my biggest piece of advice would be very deliberate, educate your stakeholders, and manage expectations around this.
Thank you, everyone. I thought that was really interesting. I hope everyone in the audience did as well.
I have to add that, goodness, that was so thoughtful. All of you really were so generous in sharing your insights, even, exposing some of the warts and so on, which is so important. And we can't thank you enough from Talking Hedge. Hats off to Graham Capital for coming to us with this fabulous topic idea. I think we could have talked about it all day. And I hope we can revisit this topic. It's incredibly important, and so many insights shared today, I think probably really help take the blinders off certain people. And I really appreciate all of you contributing. Thank you to the panel, and thanks for tuning in, everybody.